Hello everyone, we are group number 10 and we will be talking about the rationale of Paytm and Nykaa's extraordinary valuation. Starting with Nykaa. So Nykaa is a cosmetic to fashion platform that had a blockbuster launch where the company valued at about $13 billion. The IPO price was rupees 1,125, which was 79.4% higher than the debut price. The company's IPO was oversubscribed by roughly 82 times, indicating a high investor interest for a startup. Although Nykaa leads the online beauty and personal care market in India, it is important to understand previous slide. It is important to understand its long-term potential in the competitive space. To ensure a clear understanding of the same, let us look at Nykaa pre-IPO analysis. Next slide. So Nykaa is a D2C customer product e-commerce brand which relies on an inventory-based business model. The company purchases its products directly from the manufacturers and keeps them in designated warehouses located in New Delhi, Mumbai, and Bangalore. These products are sold either on the website of Nykaa or through its three offline store formats: Nykaa Lux, Nykaa On Trend, and Nykaa Kiosk. The inventory-led business model of the company helps the company witness high profit margins and has resulted in the profitable business. Besides, the company also ensures authenticity of products and follows competitive pricing. The company also offers comprehensive content that includes product reviews, beauty how-to videos, expert written articles, and even an e-commerce magazine. Next slide. Moving to the competitive edge of Nykaa's business offerings. Superior market share. Nykaa's market share in the beauty and personal care space is estimated to be more than 18.5%. It is the single largest share by a new age startup, while other companies including Purple, Pure Play, MyGlam, and Mamaearth hold less than 2% of the addressable market. Strong brand value and customer loyalty. It has a significant brand value and customer loyalty in the market in FY 2021. 70% of the gross total merchandise value on the platform was generated by existing customers. The share of existing customers in the total GMV jumped by 15% points from 55% in FY19. Sound financial performance. It has a sound financial performance in FY21, including a positive EBITDA, free cash flows, and high ROCE, indicating that the company's fundamentals looked strong. In an ecosystem where 1 out of 4 funded startups is EBITDA positive, it showcased strong financial fundamentals before an IPO, and that drove the bullish segments. Strong influencer network. A strong influencer network of 1,363 is another plus. Research by Google on Indian beauty and personal care consumers concluded that 81% of the BPC customers in India have engaged with at least one beauty influencer on YouTube. This underlines the importance of influencer marketing in the journey of a potential buyer. Online offline business model. It is successful in leveraging online offline product ecosystem. Despite the growing customers' internet utilities in India, it is important to note that by 2025, the offline beauty and personal care segment is expected to come at 82% of the total revenue share. Therefore, Nykaa's expansion in offline retail is positive indicator when it comes to long-term sustainability of revenue and market share. Its official stores also enable Nykaa to fulfill last mile delivery of local online orders, which is a smart way to expand the company's reach beyond tier 1 cities. Next slide.
Let us now focus on the Nykaa's value proposition. When it comes to customer loyalty, the percentage of existing customers in the company's total annual gross merchandise value portrays high customer loyalty towards the brand, as explained by Sugandha earlier. When it comes to private labels, expansion of the private label portfolio is a core part of Nykaa's growth strategy. This may result in exponential growth as the addressable market for D2C brands in India is projected to reach more than $100 billion by 2025, while the brand enjoys high customer loyalty among its 11 million transacting users. Its focus on private labels such as Nykaa Cosmetics, Nykaa Naturals, and others will enable the company to ensure higher profitability and quality control. When it comes to influencer marketing, millennials and Gen Z customers who are the primary target audience of Nykaa and other online beauty and personal care retailers, are digital natives and have a habit of making informed purchase decisions by reading or watching online blogs. With a network of around 1,363 influencers as of March 31, 2021, Nykaa has the largest influencer network in India's online beauty and personal care sector. Talking about the supply chain and last mile delivery, supply chain optimization and faster delivery time, they're emerging as the new norms in online commerce. A survey by one of the company highlighted that 80% of online shoppers expect same day delivery. During the pandemic, Nykaa has also started leveraging its physical stores for last mile delivery of local online orders, indicating that company is using its physical stores as fulfillment centers for faster development. Besides 73 physical stores across 38 Indian cities, companies commanding a network of 16 privately owned warehouses and 2 outsourced units. Talking about reasons for high valuation, on left hand side you can see a bar graph wherein the share of existing customers is more to total gross merchandise value, which depicts the customer loyalty to Nykaa. Another strong reason for high valuation is that 18.5% of total addressable online beauty and personal care market is captured by Nykaa. Operating revenue increased by 60% as compared to financial year 20. Let us now focus on the fundamentals of company. On the left side, you could see company generating a free cash flow of $14.6 million, whereas on the right side, operating revenue rate is increasing more than the total expenditures rate of increasing. Nykaa also had the lowest ad spend to operational revenue ratio financial year 20, which is 11% as compared to its competitors, including Sugar, MyGlam, Purple. Concluding the IPO analysis of Nykaa, in the nutshell, with increasing e-commerce shoppers, Nykaa will be able to increase its revenue as only 21% of internet users in India are e-commerce shoppers.
Now let's just look at about Paytm. So giving you a brief about Paytm. So Paytm, abbreviation of which is Pay Through Mobile, is an Indian multinational technology company that basically specializes in digital payment system. It was founded in August 2010. The founder was Vijay Shekhar Sharma, who resides in Noida, Delhi NCR. So first it started off as a prepaid mobile and DTH recharge platform. Thereafter, it started offering various online use cases, the detail of which I've explained in the next slide. Next slide. Yeah, so starting in the initial year 2013, which was just postpaid and prepaid mobile bill payments, 2014 started with the Paytm wallet, followed by utility payments and other uh, payment services in 2015. In the 2015, it got a major stake from Alibaba Group as well. 2017, it launched Paytm Gold and Paytm Payments Bank. In the year 2018, it started the Paytm for Business app, along with the launching of two new wealth management products, Paytm Gold Savings Plan and Gold Gifting for long-term savings. 2019 came Paytm First, which offers variety of offers and discounts for categories like food, travel, shopping, etc. In the year 2021 was a milestone for Paytm with the launch of its IPO in November 2021. Next slide. Coming for the competitor analysis, so we found two close competitor to Paytm, that is PhonePe and Google Pay. So founding year for all of these three were 2010 for Paytm, PhonePe 2015, and 17 Google Pay. So I just give you a look out for their UPI year starting. So PhonePe was the first Android app to come in service very early in the year 2015, followed by Google Pay and then Paytm in the year 2018. Talking about the user base, so Paytm has in the comparison of 3, they have a 250 million plus users, followed by PhonePe and Google Pay with 8.5 million. Transaction limit, if we have categorized with wallet and UPI in the case of PhonePe and Paytm, so 1 lakh for wallet in the case of Paytm and 1 lakh plus for UPI bank transfer. In the case of PhonePe, it's 10,000 for wallet and 1 lakh for UPI. And Google Pay, obviously the UPI is more than 1 lakh. Comparison in case of languages offered, Paytm offers 11 language, whereas Google Pay on the other hand, 7 languages. Transaction volume here as on date Feb 2021, the largest was PhonePe, which amounted to 968.72 million, followed by Google Pay and then Paytm.
Yes, so the India's largest initial public offering that raised almost 18,300 crores from its investors lost almost a fourth of its valuation on the listing day. Fintech app Paytm's parent company 197 Communications Limited ended its debut trading day at a discount of 27.24% on the issue price of rupees 2,150 per share, with a shadow over both firms' IPO pricing and the dream run of tech companies in public markets this year. Paytm listed at a discount of 9% at rupees 1,955 on the BSE and closed at rupees 1,564.15 rupees, down by 27.24% from their IPO prices. Trading of the script was halted after it hit a lower circuit in the latter half of the market hours. Next slide, please. So as we can see that a week ago, the Paytm closed at rupees 9, Paytm shares closed at rupees 960. And if we look at today's valuation, it's less than 900 rupees. So why is this stock performing so poorly? So an inflated valuation and large float were mainly responsible. Institutional investors have flagged concerns with the company's growth prospects, considering the absence of a license to enter the lending business, one of the most lucrative verticals in the fintech space, and the intense competition in the segments of Paytm's operation. Paytm's valuation was expensive, 26 times its estimated price to sales ratio for year 2022-2023. When the global benchmark is 0.3 to 0.5 times the price to sales growth of a fintech firm. Also, stock analysts have pointed out that the valuation of the company has traditionally been decided by foreign investors with a high risk appetite, whereas Indian public market decide based on conventional profitability and earnings metrics. Next slide, please. So some of the strengths and weaknesses associated with Paytm valuation are, talking about the strengths. It has an ecosystem that allows the company to address multiple large market opportunities at scale. It is a trusted brand having a reach across the country. Its deep insight of Indian merchants and consumers. The company builds technology in-house and believes in innovation. It has experienced promoters with a strong management team. The risks and the weaknesses are its dependency on the company's ability to maintain and grow its relationship with existing merchants and increase the volume of transactions processed on its platforms. The dependency on the company's liability to generate repeat use and increase transactional volume from existing consumers and to attract new consumers to its platform. Majority of revenue is derived from payment services. A failure to maintain or improve its technology infrastructure, dependency on financial institutions as partners for providing financial products and services, a history of net losses. If I checked it, and like for this year, Paytm lost around 1,600 crore rupees as net losses. So it was huge. The company participates in markets that are competitive with continuously evolving technology and consumer needs, and its dependency on third parties for certain aspects of its business. Next slide, please.
So now that we saw the brief overview of the Paytm company and also its IPO, it's time to look at some of the reasons behind its valuation. To understand Paytm's valuation better, let us have a look at few of the reasons given by Professor Ashwath Damodaran, who is regarded as Wall Street's Dean of Valuation. A decade ago, there were less than 3% Indians who had smartphones. However, by 2020, this figure increased to more than 500 million smartphones in India, thanks to the Chinese companies who offered smartphones at much affordable rates. This, coupled with the low internet rates provided by Reliance Jio, boosted the adoption of smartphone in Indian market even further. So as the number of smartphones increased, so did its usage. And in 2020 survey, it was found that India ranked third in mobile phone usage with average use of 4.6 hours per day. Next slide. So Professor Damodaran sees great growth opportunities for Paytm in Indian markets, as we see significant rise in the mobile payments over card payments in last 2 to 3 years, where COVID worked as a catalyst to surge the mobile payments transactions. Another important parameter for Paytm's valuation is its investors. Giant financial players like Alibaba, SoftBank, SAF, Berkshire Hathaway, etc. have major stake in Paytm. Next slide. Now let us look at few of the value drivers of Paytm in little detail, along with certain corresponding assumptions made. Gross merchandising value, or GMV, is the Paytm's lead value driver. It's the metric that measures the sale of the company over a period of time, and currently Paytm has rupees 4,033 billion in GMV. Second value driver for Paytm is its market share in P2M market, and it's dominate the market with more than 50% share. Assuming that Paytm will maintain its dominance in coming years as well. Paytm's major weakness lies with its take rate, as it has gone to 0.79% from 2% in past. Take rate is the amount of money paid by every single rupee transacted on the platform. Paytm is expected to turn profitable, assuming it gradually increases its take rate to 1% in next 5 years and double to 2% in years following. One of the major reasons of Paytm currently losing money is its high operating cost, with major chunk of the cost being spent on selling and marketing after its employee cost. It is assumed that Paytm would gain economies of scale with respect to its operating margins as it grows bigger in size. The last value driver for Paytm is its reinvestment strategy. Since recently, Paytm has been investing its capital majorly in acquisition of companies and technology. This could majorly increase Paytm's revenue, assuming it generates a revenue of ₹3 for every rupee spent. Now to conclude, let us put everything together, that is the macro factors like increasing smartphone penetration and its usage, cheap internet connection, increasing mobile payments, foreign big investors, and finally, all the value drivers. Professor Ashwath Damodaran has given a valuation of $19 billion to Paytm, which is around rupees 1.406 lakh crores. Thank you.